Investing is not only about making money, but also about keeping it and growing it. The rich have a different mindset and approach to investing that enables them to preserve and increase their wealth over time. In this video, we will explain 8 things that the rich never invest or do, and how you can apply them to your own investing strategy and behavior. 1. Things they don't understand. This means that wealthy people are careful and strategic about how they use their money to generate more income. They do not blindly trust others or gamble on risky ventures without doing their homework first. They make their investment decisions based on facts and logic, not emotions or peer pressure. They also evaluate each opportunity carefully and align it with their goals and values. An example is how Warren Buffett, a rich and successful investor, he follows the principle of value investing, which means buying stocks of companies that are undervalued by the market, but have strong fundamentals and growth potential. He also studies financial reports and books and learns from other experts. 2. Speculative assets. This means that wealthy people are smart and cautious about how they grow their money. They do not buy things that they cannot sell quickly or that may lose value over time. They prefer liquid and stable assets that provide steady income and avoid risky and volatile assets that depend on chance. An example is how Jeff Bezos, the founder of Amazon and one of the richest people in the world, invests his money. He invests mostly in his own and other successful companies, which are liquid and profitable. He does not invest in things that he does not understand, too speculative or luck-based assets, such as Bitcoin or gambling. 3. Non-productive assets. This means that wealthy people are wise and frugal about how they use their money to create more wealth. They do not buy things that depreciate in value or that do not bring any cash flow. They prefer assets that appreciate or generate income and avoid spending on unnecessary or extravagant items. An example of this is how Mark Zuckerberg, the founder of Facebook and one of the richest people in the world, invests his money. He mostly reinvests his money into his own company, which is very valuable and profitable, and also into other innovative businesses, such as Instagram, WhatsApp, and Oculus. He avoids risky investments that he does not trust and lives modestly, donating most of his wealth to charity. 4. Inefficient accounts. This means that wealthy people are savvy and proactive about how they minimize their tax liability. They do not keep their money in accounts that are subject to high taxes, such as ordinary income or short-term capital gains. They use legal ways to lower their taxes, such as retirement accounts, charity, or tax-advantaged assets. They also work with tax experts to plan their tax strategy and use the rules and regulations to their advantage, such as claiming deductions for business expenses that reduce or eliminate taxes. An example of this is how Bill Gates, the co-founder of Microsoft and one of the richest people in the world, invests his money. He holds his money in his foundation, which is tax-free and supports various causes. He also invests in stocks with lower taxes, gives to charity, and works with tax advisors to help him find ways to save on taxes. 5. Investing in only one or few assets. This means that wealthy people are prudent and flexible about how they allocate their money to different investment options. They do not rely on only one or few assets, but diversify their portfolio across various types of assets, such as stocks, bonds, real estate, commodities, etc. They diversify their portfolio across various assets, sectors, regions, and strategies to reduce risk and increase returns from different sources. They also rebalance and change their portfolio periodically to align it with their goals and market conditions. An example of this is how Ray Dalio, the founder of Bridgewater Associates and one of the richest and most successful investors in the world, he follows the principle of all-weather investing, which means he diversifies his portfolio across different asset classes, sectors, regions, and strategies, including both traditional and alternative investments. He also rebalances and changes his portfolio periodically using a systematic and rules-based approach in his insights and research to keep his portfolio aligned with his risk and return targets and the economic scenarios. 6. Investing without rebalancing. This means that wealthy people are attentive and proactive about how they manage their money to achieve their financial goals. They do not leave their money in the same investments for a long time, but they periodically check and adjust their portfolio to keep it aligned with their financial goals. They also use market movements to buy low and sell high, while also optimizing their tax liability. An example of this is how Warren Buffett invests his money. He follows the principle of value investing, which means he buys stocks of companies that are undervalued by the market, but have strong fundamentals and growth potential. He sells overvalued or underperforming stocks, reviews and rebalances his portfolio regularly, and uses market fluctuations to optimize his profits and taxes. 7. Investing without a margin of safety. This means that wealthy people are selective and careful about how they choose their investments. They do not buy assets that are too expensive or too risky, meaning they have a high chance of losing value or not meeting their expectations. They look for assets with a margin of safety, which is a concept that compares the true value and the current price of an asset to measure how undervalued or safe it is. An example of this is how Benjamin Graham, the father of value investing and the mentor of Warren Buffett, invested his money. He followed the principle of buying $1 for 50 cents and looked for undervalued stocks with a margin of safety of at least 50%, while avoiding overvalued stocks and diversifying his portfolio. He also avoided stocks that were trading at a premium to their intrinsic value, based on their popularity or speculation. He also calculated the margin of safety for each stock by subtracting the market price from the intrinsic value and dividing it by the intrinsic value. 8. Investing without an exit strategy. This means that wealthy people are disciplined and rational about how they end their investments. They do not hold onto their positions indefinitely, but they have a clear plan that specifies when and how to sell their assets based on their expected return, risk tolerance, and investment objectives. They also stick to their plan and do not deviate from it due to fear, greed, or other psychological factors. An example of this is how George Soros, one of the most successful investors in the world, invests his money. He follows the principle of reflexivity, which means how people's beliefs and the actual situation affect each other, and uses a stop-loss mechanism, which means he sets a predetermined price at which he will exit if he starts losing money. Using a rigorous and scientific approach, he reviews and adjusts his portfolio regularly to adapt to the changing market conditions, and he avoids emotional attachment to his investments, admitting and correcting his mistakes. In conclusion, the rich invest smartly. Therefore, the rich have a different approach to investing than most people. By following rules and routines that help them excel at investing and avoiding bad or risky investments, they achieve financial success. Thank you for watching. I hope you learned something new and useful. Please leave a comment below and let me know what you think about it. I'll see you in the next video.